The Federal Reserve has claimed that they were going to reduce their balance sheet beginning in October of 2017. They've really been dragging their feet. However, we have seen some level of unwinding. But as soon as the stock market crash in 2018 occurred, the Fed immediately reversed course and printed a big pile of cash. This is more evidence that these markets rely solely on central bank intervention. You came here for the truth, so let me unveil that for you. Today we're going to talk about the Fed, we're going to talk about leverage, debt, and so much more. Let's begin by taking a look at the S&P 500 as well as the Fed balance sheet. And you can see that after this big drop that we saw, the market began to rise upward. It just so happened, just a coincidence, to be completely correlated with the Fed's balance sheet. And yes, we have seen some deleveraging here that has occurred, but what's important to note is that the Fed balance sheet is completely correlated to the stock market on the way up, on the way down. This is in effect a temporary QE4. Anytime the market goes down, the central bank will swoop in and print up some money. Look at this. You can see this here, Fed balance sheet, and they have information highlighting what has happened. The Federal Reserve assets totaled $4.4 trillion in the February 14th week, up $14 billion in the week, and down $25 billion since the unwinding October 2017. So they were actually printing a relatively large sum of money, and that will, of course, help the markets out. This is effectively, as I said, a temporary QE4. If the market is going to come down somewhat, they are going to react. They're not going to let it happen. They're going to put a floor in there. Surely this could be a multi-stage event, but the stock market will halt trading at particular points. So they will never let it go too low in one particular trading session. There will have to be some sort of tumble action that they cannot react fast enough. So I'm interested to see how it all unfolds in the near future. All right, now we look at this. Surely we're going to get to this point, definitely, where you can see historical economic recoveries average 41 months. We're going to surpass this period of time here. We will definitely be at the second most. It's going to surpass this one. Whether it goes beyond the 119 that we saw a few decades ago, that remains to be seen. But surely it will be at least the second longest recovery in history, in all of history of the US. When you look at the average recovery being 41 months, and it's gone now more than double on its way to basically triple the average, we need to start asking questions. What has brought it to this level? Is it sustainable? And how will it look on the way down? Nobody ever addresses those concerns because they believe they're coerced into thinking that it simply cannot happen. And I assure you, it's going to have to happen at some point. Historically, it's gone on far too long. Now, let's take a look at this. Fed and the 10-year interest rates versus real economic growth. You can see this for yourself if you're interested. One of the most important things that I've always referred to, and I know many others do, the Fed funds rate back in, let's say, 1980, 1981 time frame, we saw it peak out. And that was an extreme example, surely. But even if you were to, let's say, normalize that range, we are still historically in no man's land. It's completely distorted the markets in every possible way. You can't get real growth. You can't get real savings. You can't get people to act normally in this period of time because they're not going to make any money. And it's all about making money. That's what it is. And they want more corporate profit, so they have to take more risk. The pension funds need to take more risk. The stocks need to be all about corporate profits. And so, it's all fine. It's all good. Take on more margin. See what happens. Speaking of margin, total system leverage. Government, corporate, household, margin, and banks all together. That's the red line. And you can see how ridiculously high this has become. And the blue line is the S&P 500. We've gone into a territory that was never predicted by anybody. Even the Keynesians never thought that it would get to this level. The amount of leverage in the system and the amount of interconnectedness is a recipe for disaster. That's what's different between markets today and, let's say, 40 years ago, even far beyond that. I had an argument with a money manager, and the individual suggested that what we are experiencing today has nothing to do with what we saw 100 years ago. And in some cases, there wasn't that same globalization. We didn't have interconnectedness of the markets. But he was presenting it to me as if, we're in this new economy and things are going to be great forever. And so this fool will unfortunately have to pay the price at some point. What we are experiencing today means that when there are crashes, they're going to be more severe and they're going to be global. So there will be no place to hide. Through conventional means, if you're a traditional portfolio manager, if you are some sort of money manager for, different organizations out there, financial institutions, where are you going to do it? Where are you going to put your money? Bonds, stocks, maybe you'll try some index fund ETFs. You're going to go money market. What are you going to do? You're going to lose clients' money. That's what you're going to do. Okay. This just very quickly, just wanted to touch on it. S&P 500, you can see that peak to trough, how it's performed over these different recessions, depressions throughout the years. It's interesting, to say the least. I would say, when you look at it, averages since 1871, it's about minus 30, just under that. And since 1900, it's minus 30. So we can, give our approximate there and suggest that, it's going to be about minus 30 the next time around. I would have to suggest, however, that it's going to be worse because as time goes on, it only gets worse. And the last time around was 50% during the financial crisis, a 50% drop. Now, if you think about it, what really happened during the financial crisis? We saw that derivatives exposed the weakness, the fragility, and there was maximum risk in the system. Okay, we had some failures that existed. We had, volatility going crazy. We had, basic, fundamental, let's say, exposure of what's really happening in the system. But we didn't see any real dangers that existed were brought to the surface. If you think about it, really. I mean, the derivatives started to unwind, but they were wrapped back up. You saw some corporations fail, but ultimately the assets were gobbled up and restructured. You didn't see any countries really in a state of catastrophe, although they should have. You just had basically the transfer of wealth from the nations out into the private hands, selling off their precious assets and things like this. So those underlying failures that are present in the system today have actually been expanded since this region, 2007, 2009 area. And unfortunately, this eventually has to come up. When it happens, don't know how the stock market will be at the time it happens. I don't know how far it's going to drop down. All I know is that people are not prepared. People are never ready. In a 50% drop, people think that, well, I can withstand the 50% drop. That's fine with me. Nobody ever says that. Nobody ever is able to deal with a 50% drop. A lot of these people are going to be losing out big time because they've bought on margin. They bought the wrong stocks. They chased everything. And along the way, they will be selling off because they're scared, or they hold on until the bottom. And this period of time here ends up taking very, very long, longer than they would have hoped. This is what generally occurs in market corrections. Now, if you hold on for the long term, that's totally fine. However, in many cases, if you look at the NASDAQ, it took, 15 years in order to get back to where it was before, maybe 14 or 15 years, not even factoring in inflation. When you do so, it's far beyond that. That's the type of thing that people don't really take into account because everyone's a money manager, everyone's a professional, and I salute you all. Don't go anywhere. Make sure you watch part 2. I'm going to talk about the government's own admissions that they owe $49 trillion. Link is in the description below. Take care.